Thank you all for coming, and I hope you're enjoying a slightly more spacious experience than the previous press conferences. So today, as you know, the board decided to leave the cash rate unchanged. For now, the board judges that the level of the cash rate is appropriate for balancing our inflation and employment objectives, but there is still some considerable uncertainty about the outlook. And I want to highlight here that there is still a risk that inflation will take too long to return to target. So the recent CPI data were broadly in line with our expectations, our forecasts, but make no mistake, inflation is still too high, and the board does remain concerned about the degree of excess demand in the economy. Now, what I mean by that is that the amount of goods and services that households and businesses and government want to buy and need, that's more than the amount that the economy can sustainably provide, supply, if you like. To paraphrase what I heard someone say quite simply the other day was, inflation is when there's too many goods chasing the same amount of things. And when demand's above supply, that's inflation. Prices go up. So demand has been above supply for some time now, and we've been highlighting this, and that's the key reason why inflation's been so persistent. So you'll recall earlier when in the pandemic and the immediate post-pandemic period, we had difficulties on the supply side of the economy. There were things like shipping backlogs, there were shortages of certain goods, and this overlapped with a period when people were demanding a lot of goods. So there was a substantial increase in energy costs as well at the time when Russia invaded Ukraine. And all of these things conspired basically and resulted in higher goods price inflation around the world, and that was the case in Australia as well.
You're seeing inflation that's well above band, that remains above band, that has proven to be very resistant to the RBA's attempts to bring it back to that 2 to 3% level. It's sort of holding at around 4%, which is quite high and ultimately in the medium to long term very damaging for the economy. So the RBA is very worried about the fact that we've got this persistent inflation, that it's across broad-based sectors of the economy, that it seems to be driven by an excess of demand and stimulus from government. So on the one hand, you've got this pressure to keep rates going up. On the other hand, you've got the volatility in the stock markets, you've got concerns in China about slow growth, America about the uncertainty and slow growth there. We're starting to see unemployment pick up. So it's a very mixed picture, and one of the reasons I think why we've seen rates stay on hold, even if the RBA was perhaps tempted to increase rather than decrease them, is that there are so many mixed signals across different parts of the economy.
Yeah. Uncertainty obvious in convulsing stock markets stabilising today, the decision welcomed by analysts.
It reduces the risk of a recession we don't have to have.
The government relieved.
Australians are doing it tough enough already. The last thing they needed today was more cost of living pressure.
The RBA now predicting headline inflation to dip briefly to the top of its target band at 3% by Christmas, with the underlying rate trending slowly below 3 late next year.
That it forecasts that headline inflation is expected to dip below 3% in the next year due to the government's cost of living measures.
What other data are they weighing up this information against?
It's going to be a really interesting press conference, that's for sure. Look, at the last meeting, Governor Bullock said that the narrow path had just got even narrower. It's now on a knife edge. My goodness, they are trying to get inflation under control without tipping the economy into recession, without having major job losses. So that's the key, really. They can't just abandon the job of getting inflation under control. As we know, inflation went up, headline inflation, from 3.6 to 3.8 in the last set of data. Now, trimmed mean inflation is coming down, but it's not coming down fast enough. They've still got a job to do. They're not going to, lose sight of that. What could trigger a rate cut is if we see unemployment start to really tick up here in this country. It is on the rise. We're sitting at 4.1%. But if we see a flurry of job losses, that could force their hand.
So if there is no change today, will this fast forward the potential for a cut?
Look, I think anything is possible right now. Certainly, even before the stock market bloodbath, CBA Westpac said that the first cut they expected to be as soon as November. Look, if you've got a mortgage, do not think of the possibility of rate cuts. Put it as far out of your mind as humanly possible. What you've got to do at this point in time is focus on your own mortgage, focus on clearing the repayments, and call me crazy, but plan for another hike just in case. I mean, what's the downside of planning for a hike? You might be over prepared, but when it comes to the mortgage, that's okay.